The artillery has stopped firing, and now the survivors are looking around, trying to see who is left standing. If you're staring at Supermicro's $30 price tag and feeling that sinking pit in your stomach because you remember when this stock was the darling of Wall Street, trading at much higher post-split equivalents, you are far from alone. Over the last 3 months, SMCI has fallen roughly 44%, and the prevailing narrative has been crushing. Accounting irregularities, delayed 10K filings in late 2024, and the abrupt resignation of Ernst & Young have led the market to view this company as permanently damaged. Bears are shouting that this is a low-margin hardware assembler that got caught playing games with its books, and that now, as the AI hype cycle moves into a show-me-the-profits phase, SMCI is destined to fade into irrelevance. They point to the missed earnings from November 2025, where EPS came in at 0.35 instead of the 0.46 expected, and conclude the company is in structural decline. But this is where perception diverges sharply from reality. In truth, Supermicro is trading at a PE ratio of roughly 22x, far below its peers in the AI infrastructure space, many of whom command multiples nearly double that. While the market obsesses over the past, the forensic accounting, the auditor drama, the executive turnover, it is ignoring the physical reality of what's happening in data centers today. The revenue miss last quarter wasn't because customers stopped buying. It was because NVIDIA's Blackwell chips were constrained, and you simply cannot ship a server without the CPU and GPU cores powering it. With the supply chain for the GB200 NVL72 racks reopening, Supermicro now sits on a backlog that would make a smaller company crumble. This isn't a story of a dying company. It's the story of a company that was put in the penalty box by Wall Street finally lacing up its skates to get back on the ice. The chart itself tells a fascinating story. The drop to the $20 level was essentially a test of the ultimate capitulation zone. When a stock falls below its 200-day moving average and lingers there, technical funds automatically sell, creating a vacuum. But notice what happened around $29.43. It didn't keep plunging. Instead, it bounced, signaling that value buyers, quant funds, and distressed asset managers have calculated the liquidation value of Supermicro's inventory and decided that roughly $30 is the floor. What we're witnessing is a transfer of ownership from the hype-driven retail traders who bought at peaks to deep value investors who thrive on fear. Much of the negative sentiment has been anchored in the auditor drama. When Ernst & Young resigned in October 2024, the market reacted as if a nuclear bomb had detonated, expecting delisting from NASDAQ and relegation to the pink sheets. That fear is still priced in, even though the company hired BDO, implemented a compliance plan, and successfully filed their 10K. The fraud premium assumed in the stock price today effectively assumes that a bomb is still waiting to go off. In reality, that risk is approaching zero. This creates a rare arbitrage opportunity. Buying a company with a clean bill of health at prices reserved for a terminally ill stock. The story gets even more compelling when we look at the engineering behind Supermicro's offerings. Bears often reduce SMCI to a glorified Lego assembler, but that couldn't be further from the truth. If building servers were that easy, Dell and HPE would have crushed them long ago. The secret lies in direct liquid cooling. The new NVIDIA Blackwell chips are powerful, but extremely hot, consuming between 1,000 and 200 watts each. You cannot rely on fans to cool them. Air cooling would sound like a jet engine and bankrupt any data center through energy costs alone. Supermicro's building block architecture, with in-house cold plates, manifolds, pipes, and coolant distribution units, allows them to deliver fully liquid-cooled racks in weeks, while competitors wait months for third-party parts. Take the XEV Colossus cluster built for Elon Musk. 100,000 H100 GPUs were deployed in just 19 days for the initial phase. That's not assembly, it's logistics wizardry. As xAI expands Colossus to 200,000 GPUs using H200 and Blackwell chips, Supermicro remains the preferred partner. This kind of strategic relationship, where the world's richest man trusts your company to build the fastest AI supercomputer in history, is worth far more than any quarterly earnings miss. Investor psychology has played a huge role in suppressing SMCI's stock price. Retail investors who bought during the 2024 AI mania, some at post-split equivalents near $100, are understandably frustrated, many down 70%. Every rally toward $30 or $40 triggers, selling from trapped longs trying to break even, which creates a layer of overhead supply that makes upward momentum difficult. However, after a 44% decline, much of that trapped supply has been washed out. The upside from here is substantial, especially when paired with the fact that the market has been pricing incompetence or malice far higher than the actual risk. Incompetence can be corrected, malice cannot. For anyone holding shares, understanding which you are dealing with matters profoundly. Margins have also been a point of contention. Critics point to a recent dip in gross margins below 14% and conclude that Supermicro lacks pricing power and is entering a race to the bottom with competitors like Dell. But this interpretation misses the bigger picture. Supermicro is deliberately prioritizing market share over margin percentage, installing racks across major data centers such as Meta, XAI, and CoreWeave. Once a data center is plumbed for their liquid cooling loops, switching to a competitor is costly, akin to ripping out plumbing in a house. This strategic positioning locks in a long-term service tail, generating sticky, high-margin maintenance revenue for the next decade. What the market sees as low margins today is, in reality, a setup for sticky, recurring revenue tomorrow. The macro AI environment is also shifting in Supermicro's favor. In 2024 and 2025, the focus was on massive model training at hyperscaler data centers. In 2026, the attention is moving toward inference and edge AI. Companies are increasingly seeking private data center deployments for performance, privacy, and customization. This is precisely where Supermicro excels. With thousands of SKUs, they can provide enterprise-grade, bespoke server configurations. Unlike Dell, which offers a Model T approach, you can have any color as long as it's black. Supermicro offers a tailored solution for highly specialized applications, from medical imaging to financial computing. Flexibility is becoming their killer app as AI moves from hyperscalers to the enterprise. Institutional signals reinforce the long-term story. 13F filings show that while some growth funds fled during the audit crisis, quantitative and index funds quietly accumulated shares. Being part of the S&P 500 forces passive buying, and insiders have refrained from selling aggressively, suggesting confidence that the storm has passed. Short interest remains elevated because betting against SMCI has been the easy trade for 6 months. But when a trade is that obvious, it is often wrong. A surprise buyback or a nod from NVIDIA as the preferred partner for the GB200 rollout could trigger a short squeeze, sending the stock from $30 to $45 or higher in a matter of days. Liquidity on the upside is thin because nobody wants to sell at these levels, making the potential spike even more pronounced. Ultimately, the takeaway is clear. Supermicro has been unfairly punished by sentiment and fear. Auditor drama, missed earnings, and Wall Street's obsession with the past have overshadowed the real story. The company's unrivaled execution in AI infrastructure, its liquid cooling expertise, strategic partnerships, enterprise-grade customization, and long-term revenue tail. The market is pricing in fear, but the reality is an infrastructure powerhouse positioned at the heart of the AI revolution. For long-term investors, this is not just a stock, it's a rare deep value play at the intersection of technology, logistics, and AI. Ask yourself, are you holding SMCI because of fear and regret, or because you understand the tech and the long-term story? The answer will define how you approach this opportunity as the company